Let me welcome on board Ajay Bagga to pose that question on the budget. Ajay, I know that this time around it's going to be a statement on accounts of sorts, but nonetheless, it is a big event when it comes to the capital markets as well. If I had to ask you one big theme that you're watching out for, or any big announcement, what comes to mind?
Anisha, more or less, it will be the election manifesto for the ruling coalition that you will see in the budget. There'll be an enumeration of all that has got done over the last 10 years, and then what are the plans going ahead for the next 5 and 10 years. You will see that, and it will be a balance between welfare measures. We are expecting the farmer support to go up from 6,000 to 8,000 rupees, some amount of standard deduction increase to help the salaried middle class. I think those kind of measures will be looked at. How much is the support under Manrega coming? And then on the growth side, infrastructure should continue at 10 lakh plus with a moderate increase, a single digit increase, maybe 10 and a half lakh or something. The market has more or less discounted it, be it railways, be it defense related, be it power stocks or infrastructure stocks. So market, the problem we are facing is the valuations. Valuations had run too high and on a little bit of disappointment on earnings. We have seen some amount of selling coming through. Add to that the FI sellout. Now, will the budget be the cause of that? Has the budget been the cause? I don't think so. Nothing is really expected which will jolt the markets. It will be a mildly supportive budget, balanced budget between welfare and growth measures, and the infra focus will continue. We are in a good spot with the tax revenues rising. So the government will announce a lower fiscal deficit number, which the market should again cheer about.
Okay, point taken. So the markets will cheer that. But of course, you know what, Ankita, we have seen that Jan was expected to be a weak month, and that is how it played out. But the big question now, of course, in February.
That's correct. Kunal, Jan was a weak month, as Anisha mentioned. The series is down over 2% now. We are seeing a lot of FIS selling coming in there. Is this seasonality likely to continue into the month of February as well?
Well, in fact, the data actually suggests that after the series of Jan being negative month, February actually is a month where you see the index coming back into a rally or a trending mode. And historically, we've seen that the index manages to even break past about the January highs which have been made earlier. So I think if that's the case, then it could probably be a positive effect for the Jan series. And I also believe that the markets are right now being a bit more circumspect, risk averse. But then the context is more towards the domestic markets as such, because the global markets are actually into full throttle on the upside. You've seen Dow, you've seen many of the European markets, emerging markets, the Asian markets like Nikkei, etc. They are doing exceptionally well for themselves. Many of these indices have recovered from their 52-week lows. Some of them are trading at 30-year, 40-year highs, and even developed markets like US, etc. They are trading at all-time high levels. So we are at the midst of a very strong, possibly a bull market as such across the globe. And I think we just had a bit of an off month in the month of January. Hopefully, things should recover going into the month of February.
Okay, let's see whether that recovery plays out or not. But since you're talking about the global markets, there's an important cue lined up in the coming week, Ajay, and this is something you track very closely as well. The Fed decision, which is impending on 31st Jan. Of course, not major is expected in terms of a complete, change of course. But in terms of the commentary, do you expect it to be a lot more dovish this time around?
I think they will be at pains to make sure that the market understands that there are no rate cuts coming in March at least. The US economy is doing very well. The GDP numbers also come out this week. We will get the PCE index, which is the favored index of the Fed, coming out. But overall, all other the PMIs and all other indicators are pointing to a strong economy in the US in the first quarter. So the Fed need not cut rates right now. What the market discounted as a March rate cut and 6 rate cuts within this year, the Fed has been trying to push back to 3 rate cuts probably starting around July, August, and not earlier. I think that will be the commentary. The market has more or less discounted it. Today, the ECB comes out on Thursday as well, and we'll hear from them. They will also try to calm down the market frothiness and say that the battle against inflation is still not through. One more point is that the Fed is trying to mop up liquidity. It just raised the lending rates in its discount window in a bid to take out some liquidity from the market. So that seems to be a precursor for QT being called out. So that will be another thing we'll be watching out on the 31st announcement.
All right, thank you so much for joining us, gentlemen. But on that note, it's time for us to slip into a short break. You don't go